Welcome back. Today, we're cutting through some of the usual market noise. We're going to peek into a really fascinating report, one that gives a unique view on the stock market.
Yeah, it often feels like this huge, unpredictable thing, doesn't it? All that data, news flying around.
Exactly. So this is a stock market today and historical performance analysis, specifically for July 31st, 2025. And what's really compelling isn't just the data itself, it's how it was put together.
Ah, the origin story.
Right. It's entirely based on public historical market data generated using advanced automated systems, AI, machine learning, natural language processing, the whole suite.
Aggressive tech.
It is. Now, just to be clear, our mission today isn't giving financial advice. We're definitely not trying to predict the future here.
No crystal balls.
Far from it. It's more about understanding the historical patterns, the trends these AI systems have found, helping you, cut through the daily noise and get informed, fast. We'll pull out some genuinely surprising facts.
And I think what's valuable about this specific report is its objectivity. It's purely educational, just helping us understand past market behavior better.
Right.
The AI pulls together just vast amounts of data without any personal opinions, no recommendations. That's crucial for unbiased learning. It really shows how tech can sift through all that complexity and find these, well, digestible patterns, historical habits almost.
Okay, let's jump right in then. The immediate pulse was happening on July 31st, 2025, according to this AI analysis.
Let's see the snapshot.
So on that day, the S&P 500 was apparently showing pessimism. But here's the interesting part. This was even though the news sentiment was classified as positive with increasing caution.
Positive with caution. That's a key qualifier.
It is. And for that week, the S&P 500 dipped just 0.38%. But the VIX, the volatility index, the fear gauge, it jumped 8.64%. That's a pretty big leap.
Okay, so that pairing, positive-ish news but with caution, a pessimistic S&P and a rising VIX, that definitely signals some tension, doesn't
Yes,
it?
it really does.
It makes you ask, how can sentiment be positive, even with that caution, while the S&P is down and volatility is spiking? It really underscores the subtlety of automated sentiment analysis.
How so?
Well, the AI is classifying news headlines, right?
Yeah.
Those might focus on specific good news, maybe strong earnings from one company. But the overall market, the S&P 500, and especially that rising VIX, they often reflect deeper worries. Maybe things not quite in the headlines yet. Economic jitters, policy uncertainty.
So they don't always move together.
Exactly. Market direction and headline sentiment aren't always perfectly in sync, especially when that caution flag is up.
Got it. Okay, let's zoom in on the sectors for that day, July 31st. It was mostly red.
A down day overall, it sounds like.
Yeah, healthcare down 2.8%, real estate managed 1.8%, materials managed 1.3%, consumer staples negative 0.9%, consumer discretionary negative 0.8%, IT negative 0.7%, financials negative 0.6%, energy negative 0.5%.
Wow, pretty broad.
Very broad.
Yeah.
Only a couple were up or flat. Communication services actually gained 0.9%, utilities were up 0.5%, and industrials were exactly flat, 0.0%.
Okay, so if we connect that to the bigger picture, that kind of broad decline, but with defensive sectors like utilities holding up, maybe even gaining a bit.
And communication services bucking the trend.
Right. It suggests a day where investors were maybe looking for safety, pulling back from growth or cyclical areas and favoring the steadier players. It often reflects those short-term shifts in preference when uncertainty creeps in.
Makes sense. Okay, let's zoom out now. Way out. 2 decades. How have the major indices performed over 20 years, according to this analysis?
The long view. Always interesting.
Over 20 years, the Nasdaq has seen, well, a really impressive gain, plus 887%, significantly more than the S&P 500, which was still strong at plus 420%. And the VIX, as of the report date, was sitting at 16.72.
That Nasdaq number, 887%.
Yeah.
That's staggering. It really showcases the whole tech and innovation story of the last 2 decades, doesn't it?
Absolutely.
I mean, it's heavily weighted in the Nasdaq, obviously. Both indices show strong long-term growth, clearly, but that gap, it really highlights those divergent growth patterns, digital transformation impacting everything.
So what about the individual sectors over those same 20 years?
Let's break it down.
Consumer discretionary actually leads the pack. Get this, plus 148%.
Wow. Even more than Nasdaq overall.
Yeah. Closely followed by information technology at plus 976%. Industrials also had a really strong run, plus 911%.
Okay, so consumer discretionary, IT, industrials, powerhouse sectors over that period.
Definitely. On the other end, real estate saw only a plus 92% gain over 20 years, Financials were plus 354% and communication services plus 127%.
That's a huge contrast, isn't it? The difference between consumer discretionary's boom and, say, real estate's much slower growth over that specific two-decade window.
Massive
It
difference.
really speaks volumes about, changing consumer habits, the rise of e-commerce, all those tech advancements driving wealth. And it raises a big question. What underlying economic shifts explain why these gaps are so enormous? It's not just what went up, but the forces behind it.
And looking at different time frames within sectors reveals some interesting stuff too. Take energy, up 631% over 20 years, which is huge.
Solid long-term performer.
But in the last year covered by the report, it was only up 0.8%. Over the last 5 years, it was up almost 180%.
Ah, okay, so that really highlights sector rotation, doesn't it? A massive run over 5 years, then maybe a cool down in the most recent year, probably tied to commodity prices or global supply stuff.
Seems likely. And utilities, they were up nearly 5% in the last month alone, but also up over 600% over the 20 years.
Yeah, utilities show that classic defensive quality. Recent strength may be reflecting some market jitters, but solid long-term performance too because, well, they're essential infrastructure. Holds value in uncertain times.
Okay, now this is where, for me, it gets really interesting. The report goes beyond just performance numbers. It analyzes seasonal patterns based on historical data.
Ah, the historical tendencies. This is where AI can spot things we might miss.
Exactly. Let's start with month over year, or MOI performance, based on 10 years of data. So how specific months tend to perform on average?
Okay. Any standouts?
For the S&P 500, July historically averaged a gain of plus 3.4%. And here's the kicker, a 100% gain probability in the data analyzed.
100%. Wow. Over 10 years, July was always up for the S&P.
According to this analysis, yes. November was also strong, the highest average gain at plus 4.1% with an 80% gain probability. September, on the other hand, was historically the weakest. Average loss of negative 2.0% and only a 20% chance of being up. Actually, the report phrases it as a negative 20% gain probability, which is just another way of saying 80% loss probability.
Right, the classic September effect showing up in the data.
Seems so. For Nasdaq, similar story. July averaged plus 4.2%, 80% gain probability. November, again strong, plus 4.4%, 100% gain probability, this time for Nasdaq in November. And September was also the worst for Nasdaq. Average loss of negative 2.5%, same negative 20% gain probability.
It really makes you wonder why, doesn't it? Why would certain months consistently show these patterns?
What are some potential reasons?
Well, you could speculate. Things like holiday spending cycles affecting retail, maybe corporate earnings seasons, tax implications, even just investor psychology shifts after the summer before year end.
Yeah.
But the key thing to remember is these are just historical averages found by the AI, not guarantees for the future.
Absolutely. Okay, let's get even more granular. Trading day of month effects, TDOM, again, 10 years of data. This looks at performance on specific days within a month.
Like the first day versus the 15th.
Exactly. For the S&P 500, the analysis found the 7th trading day had the highest average gain, plus 1.09%. But the 4th trading day saw the largest average loss, maggish 1.19%.
Interesting micropatterns.
And look at probabilities. The 2nd and 11th trading days had a really high probability of being up 77.78%. But the 22nd trading day, historically, a 100% loss probability in this data set.
A 100% loss probability on a 22nd trading day for the S&P over 10 years. That's quite a statistic.
Isn't it? Nasdaq showed similar tendencies. Best day was the 7th, plus 1.37%. Worst was the 4th, negative 1.43%. And those probabilities on the 2nd, 11th, and that stark 22nd day were also there for Nasdaq.
It's fascinating the level of detail. These tiny patterns, even if the percentage moves are small, might hint at systematic things, maybe related to payroll cycles, options expiries, month-end flows. Hard to say for sure.
But the AI picks them up.
Precisely. It detects these subtle historical rhythms that you'd never spot otherwise. Again, purely past patterns, but interesting nonetheless.
Okay, one more layer. Week over year, or WOY, performance.
So performance by week number across the year.
Yep. For the S&P 500, week 45 showed the highest average gain, plus 2.64%, with a 60% gain probability. Week 13 was also strong, plus 1.96% average gain, 80% probability. The lowest week for the S&P 500 was week 12, averaging a negative 1.63%.
Week 45, that's around early November, right? Tying back into November being a strong month.
Good point. For Nasdaq, week 45 also led, even stronger at plus 3.17% average gain, 60% probability. Weeks 15 and 27 also stood out, over 2% average gains. Nasdaq had a few notably weak weeks identified, week 12, week 14, week 36, all averaging losses over 1.5%.
So connecting this to the bigger picture, you start to see how certain periods of the year just tend to be more volatile or profitable historically. People talk about the Santa Claus rally, or maybe pre-earnings quiet periods, tax loss selling pressures at certain times. These weekly patterns might reflect those kinds of broader seasonal or economic cycles that influence investor behavior. It's the kind of thing these AI systems are built to find.
Okay, let's shift to the news sentiment part of the report. This is sourced purely from public news headlines, classified automatically by AI and natural language processing. So, what was the sentiment snapshot around early August 1st, 2025?
What were the headlines saying, according to the AI?
It was a real mix. On one side, you had positive earnings news, Amazon, Apple, Meta, Microsoft, Nvidia showing strength.
The big tech names delivering.
But at the same time, headlines about companies missing revenue, like Coinbase, or concerns about maybe holding back investment, like ExxonMobil and Chevron. And despite the good earnings from some, many headlines reflected wider worries.
Ah, the macro picture again.
Exactly. Things like Wall Street falls, tariffs, economic concerns drag down stocks, stocks erase early gains, market falters on inflation, and tariff jitters. There was a clear focus on an upcoming Trump's tariffs deadline and the jobs report as big market movers.
So specific political and economic triggers.
Yeah, plus news about Q2 employment costs, top forecasts, initial jobless claims rising, and increases in the core PCE price index. That's a key inflation measure.
Right, so that really highlights the challenge, doesn't it? The AI classifies sentiment, but you've got these contradictory signals, strong tech earnings versus these big macro fears about tariffs, inflation, jobs.
How does the AI handle that?
Well, the AI categorizes and flags these themes, but it shows that the market isn't driven by just one thing. Company news can be good, but if the overarching economic or political winds are blowing cold, that can still drag the whole market down. It underscores why a human still needs to synthesize all these different, sometimes conflicting pieces of information.
Okay, so wrapping this up, what does this all mean for you, the listener, trying to make sense of the market?
What's the key takeaway?
Well, this deep dive into this AI-generated analysis shows that even without trying to predict anything, historical data, when crunched by these systems, reveals some surprising patterns.
Like those monthly or daily tendencies.
Exactly. Which months tend to be strong, which days might see more volatility historically. It's like finding fingerprints on the market's timeline, these hidden rhythms. It doesn't tell you the future, but it definitely offers a new way to think about past behavior, volatility, maybe even opportunity.
And knowledge is always most valuable when you understand how it works and can apply it critically. This kind of analysis really boosts financial literacy by showing you how market behavior can be dissected using data, objectively.
Free from human bias.
Right. It pushes you to think critically about all the different factors moving the markets, not just reacting to the latest headline. And always, always remember, past performance is never, ever an indicator of future results. But understanding that past can definitely inform your perspective.
Yeah, we've seen how these automated systems can take incredibly complex data and distill it into understandable trends, like the long-term dominance of tech and consumer discretionary, or those really specific statistical habits within months, weeks, even days.
The patterns are definitely thought-provoking.
So as you reflect on this, here's a final thought to consider. In this age where we're just flooded with information, how does knowing about these historical patterns found by an impartial AI change the way you perceive the market's so-called unpredictable nature? And what new questions does it make you ask about your own understanding?